So, Larry, it was quite a week this week for economic numbers. Certainly in the United States, we had the CPI numbers, we had the PPI numbers, we also had retail sales numbers. And what I took away from it is, you know what, we're not close to a recession, that's for sure. On the other hand, that inflation is not coming down very fast. Do we need to rethink exactly what we're doing as we try to approach inflation?
David, here's how I think about it. The Fed's been trying to put the brakes on, and it doesn't look like the brakes are getting much traction. And when your brakes don't get much traction, two things happen. You can be moving too fast, that's the inflation pressure, and you can be setting yourself up for some kind of collision or crash down the road. And both of those things, I think, are real risks in this environment. We clearly have an economy where demand is super strong, the highest ratio of vacancies to unemployment we've ever seen, retail sales on fire, the economy creating jobs faster right now than population growth by a factor of 5 in the latest month. If you look at the broadest measures of inflation, the median inflation component at its highest rate in 40 years, running close to 7%, a general broadening of price pressures. So that has got to cause real concern about inflation. It's got to at least raise a question about the paradigm market observers have had of how many 25 basis point increases before the long pause and move towards decrease. It raises the possibility that we're not landing at a terminal rate sometime in the next several months, or that we're going to have to go back to hitting the brakes harder by more than 25 basis points. At the same time, the Fed has to be very careful. I don't think those who think inflation is slowing, therefore it's obvious that we've got to hit the brakes very hard, necessarily are right, because if you look at accumulations of inventories, if you look at what's happened to the savings rate, if you look at how many firms have built up their payrolls, if you look at signs of a bit of euphoria coming back into some stock markets, you also have the possibility of that Wile E. Coyote moment that I've been referring to that could come, not next month, but could come sometime in the next few months.
So Larry, to oversimplify this, let me give you a multiple choice quiz here. With the Fed in March, 50 basis points rather than 25, or stick at 25 and add another 25 or 2 down the road, or do we just not know?
I think we don't know. The case for moving slowly is that when you move slowly, you preserve the option not to do the last move. Once you're sure that a move is necessary, I don't think there's any great advantage to delaying that move. And so that's why I think there are more possibilities open at this point.
Right.
But I think the risk is that we're going to hit the brakes very, very hard. And then when we hit the brakes very, very hard, that's going to kick in at the same time that some of those negative cyclical dynamics about rising savings and excess inventory and so forth are kicking in. And that could produce the dangerous drop-off.
So let's go from the Fed to the fiscal side. From the monetary to the fiscal side, we had a CBO report out that said actually the debt situation is worse than we thought, as we are now confronting a debt ceiling deadline sometime this summer. We're not sure exactly when it is. How bad is the problem, and what do you look at as a macroeconomist to figure out how bad the problem is? Because one of the issues is the more we have to service the debt, the less money we have to spend on other things that might be investments in the economy.
Look, I think that CBO report is concerning, and while there are lots of puts and takes, my guess is that the ultimate debt trajectory may well run higher than CBO is saying. It assumes that Fed funds is going to settle for the long term at 2.5 without there being a recession. That strikes me as having much more room to be too low than to be too high. CBO does its job, which is predict current policy, but my guess is that spending in the national security area is going to have to rise significantly over the next decade, given the threats that we are facing. CBO does its job and assumes current law, which is that all the tax cuts legislated in 2017 are going to phase out in 2025. But I'd be surprised if that was actually true. And so you add all that up, and I think that where they're looking for debt to GDP ratios to go to 120% of debt, an increase of about 20% over a decade, my suspicion is it could easily be 30% over a decade. And that in turn will put pressure on interest rates, which will put pressure on increase the deficit. And so you get a little bit of a vicious cycle. I don't think this is an imminent emergency. I don't think it's something that will be any kind of crisis if it is not dealt with this year. I think those who somehow use fiscal concern as an excuse to not raise the debt limit are exacerbating all of the fiscal risks. But I do think we've got to recognize that unless interest rates really revert to very low levels, which is certainly possible. It is what happened in the era of secular stagnation, that I think we are going to have fiscal problems and fiscal challenges that we are going to have to address.
Finally, Larry, next week, the G20 finance ministers and central bankers will be meeting over in India. They've got a fair amount to address here, some of which you've raised on Wall Street Week before. For example, some of the debt relief that needs to be given to some of the poorest countries on the world, and also what we're going to do with climate finance for some of those poorest countries. What are you looking for in the G20 meetings?
I hope that we're going to see continued good work along the lines of the very powerful calls that Janet Yellen has made for World Bank reform. I hope we're going to see some progress on the debt issues. I think there's a need for careful thinking about funding the ongoing economic challenges and the ultimate reconstruction in Ukraine. And I think this issue of a global economy where there's substantial inflationary pressure and the brakes are having very uneven effects, and how that's going to play out is going to be an important area that the ministers and the governors are going to have to discuss. We haven't talked about it on the show, David, but there's been a kind of possible Enron moment in India. And I imagine with India emerging as the world's largest country and the meeting taking place in India, there's going to be a lot of curiosity from all present about how that's going to play through and what, if any, larger systemic implications that's going to have for India.